Okay.
Yeah.
Cool. And you want to do the intro over here, Kevin? On
Okay.
3, 2, 1, go ahead.
Hi, I'm Kevin Hemstreet. I'm here with the Multifamily Movers podcast. Today we're introducing Skyler Stokes, discussing Delaware statutory trusts. What is a DST? Welcome, Skyler. How
Thanks,
are you?
Kevin. Appreciate it. Thanks
Yeah,
for having me.
Sure, absolutely.
So essentially what a DST is it's a real estate focused investment for folks who are looking to do a 1031 exchange. Effectively, what the Delaware Statutory Trust is, it's a trust that holds real estate assets. It could be any type of real estate asset. It could be raw land. It can be a multifamily property. It can be an office building. It can be anything. So essentially what happens is a company goes out, they acquire a property, and they put it in a trust and then basically fractionalize the ownership of that trust so that investors who are looking to do a 1031 exchange can utilize a DST and thus satisfy exchange requirements, thus defer in their capital gains. So it can be a really effective tool for folks who are either in their 45 days that can't find a property, or they're just ready to take their hands off the wheel and give it up and let somebody else kind of do it for them. So that's what a DST is.
It sounds like it's passive in a way. I mean, is that an accurate description of what
Totally.
you're describing?
Absolutely. Okay. So the way that the trust was set up is, like I said before, a company effectively, they acquire the real estate asset, they put it in the trust, and then a trustee oversees basically the entirety of the operations of that trust. So there's an asset manager on there. Investors who jump into the trust effectively have zero responsibility because it's all done by the third party. So it's 100% passive. Mm-hmm. They have no responsibility with regard to acquiring or trying to get any of the rent. No trash responsibilities, no tenant responsibilities, nothing like that. It's all done by the third party for them.
So is this an investment that would be eligible for a 1031 exchange? Most of our clients own small to medium-sized apartment buildings. They're looking for that next leap into something that might be passive at some stage of their career. And it sounds almost like a triple net lease type property, other than the fact that it's a group investment, more or less. Is that an accurate description?
That's absolutely right. So in this case, investors who, like I said before, they're trying to find a replacement property. Currently, the way that the rules are written in the eyes of the IRS, you can utilize a Delaware statutory trust to satisfy exchange requirements. Okay. So the way that they wrote it in the code basically says yes, like it qualifies for a 1031 exchange. So you can defer all of your capital gains, federal and state, just through the Delaware statutory trust, like you would any other type of 1031 exchange.
Now, what are some of the considerations? If I'm an investor, let's say I own an 8-unit apartment building and I'm looking to get into something that's passive, what are some of the considerations that I need to think of, maybe like in terms of the exit, the time frame, the obligation to stay in that investment? Tell me a little bit about that.
Sure. Usually what happens is when you're in the DST, because it's all passive and it's all third party, we usually like to say that you give the reins up and you let somebody else kind of take care of the entirety of the property, okay. Right? Which basically means that whether or not they decide to sell is totally not your decision. It's up to the asset managers and the sponsor. Okay. Usually what we like to say is there's a roughly 5 to 7 year hold period of a DST during the time that you actually invest in that particular property or properties. But that doesn't mean that it's a strict 5 to 7 year time frame. There are instances in which DSTs have gone full cycle. What we say full cycle, which is basically the equity gets raised, the property performs, that's what's intended to do, and then it sells after 3 years. There's other instances where the property gets held for 8 or 9 years, maybe even 10 or 11 years. So it just depends on what the market cycle is, where we're at, and then what the economics of that particular deal look like. Because at the end of the day, you have to remember that the asset managers have a fiduciary responsibility to act in the best interest of the investors. So if, like in an environment like we're in right now, if interest rates are going up and they're going to have a hard time finding a new property, more often than not, the asset managers and sponsors are going to hold on to that property so that they continue the cash flow. Mm-hmm. So the investors get more cash flow, and then while they're kind of riding out this next cycle, then at a later date they'll decide to sell the property, thus locking in any potential upside gain that the property had.
Got it. Now, speaking to the time frame and the cycle, how does it work with taxes and things like depreciation, taking on debt? Those are all major considerations, right? That's one of the reasons why traditional investors who buy commercial real estate, apartments in particular, that's one of the main advantages: depreciation, leveraging debt, principal pay down. How does that work when you invest into or do an exchange from an apartment building into one of your Delaware statutory trust investments?
Sure. What I'll say is one of the, like you explained, Kevin, perfectly, most of the time real estate investors utilize real estate because of the tax benefits they get through the depreciation, the long-term hold of the property. It's a really great way to accumulate wealth over your life cycle and then pass it off to your heirs. Most of the investors that we work with, they either paid off their property completely, or they're trying to find a way to leverage their property so they buy more property, right? In the event where someone has, let's say, 50% loan to value in their current property, they're trying to sell it, the DST already has the loan built into the offering, which basically means that if an investor is trying to find a replacement with the same amount of debt, they can utilize a DST and then basically transition into the DST and satisfy the debt requirements. They're not responsible for any of that debt because it's not in recourse. The sponsor basically takes it on as they do for everybody else. So the debt is non-recourse to the investor, which means they don't have to actually go out and find their own loan. They don't have to get loans. There's no loan document signing. It's all done for you.
So wait a minute.
Yeah.
You mean to tell me that they get it to capture the benefits of having the debt without the downside of being liable for it?
That's correct.
More or less.
That's correct.
Okay.
Yeah.
That sounds like a huge advantage, but that also spins the other way. Are these highly levered deals that are inherently very, very risky? I mean, it's very challenging to take a free and clear apartment building and trade into something that's highly levered, has a tremendous amount of debt, whether I'm liable for it or not, just in terms of the viability of the investment. How does that work? I mean, is there
Sure.
comfort in landing on this type of an investment, and what are the risks associated?
Sure. Most of the DST structures that we're looking at, I personally am a big fan of multifamily right now. I think multifamily is I think as an asset class where we're at right now, the shortage of housing around the country, I think it's a great property asset class to be in. In the case where a sponsor is offering a multifamily property, what they'll do is, again, they'll do their own due diligence on the property and then they'll put it into the trust. They'll get financing on it and everything is basically done like we talked about. In order for them to feel comfortable and investors to feel comfortable, there's a certain debt to service coverage ratio that they basically run through with all the expenses and fees and everything else. So most of the DSTs that we look at in the multifamily space, for me, I would feel comfortable with a certain debt to service coverage ratio for investors. So of course, in any sort of investment, there's going to be some sort of risk, right? Whether it be market risk or
Sure.
tenant risk or things like that.
Sure.
But these sponsors, they're some of the largest companies in the real estate business.
Mm-hmm.
So they have a lot of experience in actually checking these deals out, and before they even bring them to market, they're doing tons of underwriting to make sure it's actually a viable property.
Well, that brings up a really good point. So it's safe to say that they basically stress test these investments going into them prior to acquiring them. They underwrite them, they assess the risk, and then based on that, then they acquire them and then offer them in this kind of fractured capacity. Is that an accurate kind of description?
Yeah, absolutely. Most of the deals too, they'll the sponsors will actually write out a pro forma for about 10 years, just to show you here's what their projections are, here's what their rent growth is expected to look like, and it looks very similar to every other type of pro forma when you're doing some sort of due diligence and analysis.
Okay.
But because they are securities, these are securitized by their structure. They go into a lot of detail with each of the expenses that they expect over the next 10 years. So when you're doing all these analyses, you can see, at the very bottom line, here's what the net would look like for the investors, including all the expenses and costs and fees, and then the tax equivalent yield of that property as well. So
So, getting back to the kind of the stress testing and the front end evaluation that you folks do before sending it and offering it to prospective clients, this is a product that cannot be sold by a real estate broker. This is governed by the Securities and Exchange Commission, correct? And that's what differentiates who I am sitting here as a real estate broker and you as a securities broker dealer, more or less, right?
Yeah.
Can you explain to me a little bit about that higher level of oversight and how it's governed differently than, say, a traditional bread and butter apartment investment?
Sure. So each DST falls under the SEC rules, and the SEC is the Securities and Exchange Commission. We, as brokers, investment advisor brokers and registered representatives, we have rules that we fall under through FINRA, which is the Financial Industry Regulatory Authority. So what happens is these deals, these DSTs, they're created by these sponsors, and what they do is they have their own due diligence on their own properties. Then they send them out to third-party fact checkers to make sure that the property is actually what they say it is, and here's what everything looks like. Then from that point, it goes to our to our broker dealers, who do another round of due diligence to make sure that the property is actually good too. And then from there, it comes to us, and then we do our own due diligence as individual advisors and decide, this is something I do want to offer to my clients, or I'd rather pass on this and wait for something else. So we have it's a much more scrutinized investment from the I would say the regulatory authorities than a typical transaction for real estate would look like.
Yeah, no, I think there's some comfort in that, and I mean, although my experience has been referring mom and pop investors who have sold, small to medium sized apartment buildings, average sale price $2.5 million to $10 million. You were sharing with me that there are some highly sophisticated, high net worth individuals, family offices that have also chosen to divest into DSTs for all the same reasons: the tax advantages, the spreading the risk across multiple assets, but I think also the quality of assets. Is that accurate? Are there not just mom and pop investors, but high grade institutional investors seeing value in the DST offerings out there?
Sure. I think any time when you're looking at some sort of exchange and you're having either an issue with finding a property and doing your own due diligence on it, you can always use a DST as either a backup solution or as a main solution. To give you an idea, there's a case that we're working on right now. A client has a number of apartments down here in San Diego, and he's looking to basically offload that. And so what we're doing is we're trying to find either a company that can assist in helping with one particular DST for him as just the sole owner.
Primary owner.
The only owner. It's a custom deal. Or he can, again, fractionalize into multiple different asset classes in all over the country. These properties generally are, especially the multifamily, they're Class A in nature because they offer, at least in my opinion, more stabilized investment return, not necessarily returns, but a cash flow than some other properties do. In some cases, a sponsor will actually buy the property from a developer, and it'll go through lease up, and then they'll basically offer it at a DST at that point. There's other properties that are actually 95% occupied, and it's continuously cash flowing at that point. So it just really depends on what the market is. But our job is to kind of help sift through all the different deals in the market. Right now, there's about 70 in the market.
Okay.
About 40 different sponsors, and so our job is to say, Mr. and Mrs. Client, after our conversation, it seems like this is the direction that you feel the most comfortable with.
Sure.
Here's what your options are. Here's the ones that I feel the most comfortable with based off of these specific parameters.
Got it.
Yeah.
Well, and another thing that you touched on there that sounds very interesting is the fact that you're basically alluding to the fact that you can sell your 50, 60-year-old apartments and trade into Class A, basically institutional grade type product. I mean, that's very attractive. Yeah. Oh, is that the case?
Totally, I mean, absolutely. It's so the quality of property that are in DSTs is just it's amazing. These properties can range between 50 and say like a $200 million throughout the entire country. So it doesn't necessarily have to be in San Diego. I would actually argue that most of the sponsors don't like California because of the rules that they have kind of set up for property owners.
Okay.
that's not to say that there are some in California, but most of them are, within the Southeast, kind of the Sun Belt area, more tax-friendly states, Texas, Florida, Tennessee. Those areas we're finding a lot of investors kind of, moving their assets to, or finding more opportunity in. But I mean, these are, brand new properties built between 2018, 2022, just gorgeous properties. I mean, the works with the amenities of just dog washing stations in the property. There's a
So it's just overly
Oh my gosh,
amenitized. I mean,
totally.
what you would expect for a Class A building.
Absolutely.
Newer construction,
Yes.
if not new construction. Well, let's talk about that. We referred an apartment owner to you, and it's a great case study because it was an apartment owner that built the apartments originally back in, I think, the late 70s, early 80s. They had owned and operated the apartments for decades. And number one, they were fully out of depreciation. Number two, they were getting up there in age, and they decided, you know what, we're sick of the tenants and toilets and trash, and we're ready to transition into something that's a little bit more passive, but we want to stay in real estate, and we certainly want to take advantage of all the aspects and advantages of owning real estate, the depreciation, principal pay down, and future appreciation. So we referred them to you, which is what a lot of us brokers are doing these days. Can you tell me about how that worked out? I'm not even aware of what they specifically invested in. Were they similar type Class A assets? Tell me a little bit about that.
And I really appreciate that referral. That was great.
Yeah.
They're awesome people. They're one of my favorite clients. So fun. And that's exactly what we did. We basically looked at all the different properties in the market. We went through the different offerings, and we basically kind of highlighted a few that were, I think, the best in class at that moment. So we found a good apartment building in Kentucky, and then
Tell me about how many units was the apartment building? I'm just curious.
Yeah, it was 350. About
350 units.
Yeah, 350 units.
Was
yeah.
it newer construction?
Newer construction, 2020, I believe it was built.
Wow. So a 3-year-old
yeah.
Class A 350 plus unit
Yeah.
apartment building,
Yeah.
probably fully amenitized.
I
mean,
to the
pools,
works.
clubs,
Yeah.
the type of resort living, if
Yes.
you will, that you get with that type of an
Yes.
asset.
Yeah, it's a beautiful property. And then there's other, like we're kind of talking about, there are some DSTs that actually offer no debt on them. This one had debt. It was like 39% loan to value, so they added
Wow.
a little bit more debt to the property, or to their purchase, which basically is going to give them more depreciation potential and allowance there. And the next phase was basically finding another property that had no debt on it. So we found another asset class, self-storage, and 3 brand new properties built in 2020. 2 are in Phoenix, and the other one is in St. Petersburg in Florida.
Wait a minute. So hang on. So these folks were able to sell their, I think it was around $6 million. They walked with about $6 million in equity, and then they were able to splinter that equity, diversify into a Class A apartment building, 350 plus units, institutional grade apartment building, and then not just a self-storage, but different self-storage facilities in 3 different markets.
Yes.
So we're talking about a very diversified portfolio.
Yes.
Spreading the risk, 2 different asset classes, and wow, that's fascinating.
Yeah, it was. I think that the total units in the self storage was like I believe it was 2,100 units.
Wow, amongst the 3
Amongst
properties.
the 3 properties.
Okay.
And it's Class A, climate controlled properties.
No debt.
No debt.
Okay, so for that owner that's concerned about going out of state, concerned about taking on any, because let's face it, if you've worked a lifetime to pay off your apartment building, some folks are just not comfortable with taking on debt in retirement. Although you and I may have a difference of opinion for all the reasons we've discussed previously, there are options out there for the highly conservative investors, no debt opportunities that probably allow for a lot lower risk potential threshold for risk. Is that correct?
Yeah, but I would say so. I'd say, depending on the appetite for risk, clients, again, because of the non-recourse debt that DSTs offer, I think that kind of helps set a little bit of those nerves. But for those clients, just like, I just don't want to have any thought about it, right? They can use the no debt DST solution for that purpose. So it's definitely an option there.
Okay, now here's something that I got real excited about when you shared with me some ideas about a client of mine that was looking into buying a triple net lease property.
Yeah.
Oftentimes, there again, it's a stepping stone to getting away from the tenants and toilets and trash, one of our clients was looking into a brand new constructed Dutch Brothers triple net lease as an exchange option out of their bread and butter apartments here in San Diego. And he said, well, we actually have an offering that is a blended portfolio of net lease properties. And so we kind of touched on it briefly, but from what I understand, an owner of fee simple real estate can sell their apartments or their commercial property or their income property, whatever it may be, take that equity, harvest it, and redeploy it into not just a single net lease deal, but splintered throughout the country, multiple net lease properties, but it's the same concept, low debt or no debt. These are true triple net lease properties. Taxes, maintenance, insurance is paid for by the tenant. These have guaranteed leases in place. I would assume they're traditionally corporate backed, not necessarily franchisee.
Right. Corporate backed.
So these are the bond grade tenants, if you will, that we look for when we're looking for net lease properties for our clients. So I mean that's huge. I mean that's a whole new avenue where a client doesn't have to be pigeonholed into one property in a particular town in a particular area with risk. I mean there's tremendous risk. They could take that $2 million of equity and splinter it amongst 5, 6, 7, 8 different properties. Is that right?
Absolutely.
Tell me a little bit about that.
Sure. So I think one of the greatest things about the DSTs is the low minimums. Usually the minimums for the DSTs are $100,000, which is, I think, in and of itself, a really useful tool when it comes to, if you're trying to help find a property locally for a client, and let's say you do find, something that basically takes a lion's share of that equity, but they still have something that they need to fill, whether it be the debt or the equity, you can use a small amount of that to basically get into the DST, thus satisfying not only their debt, but the rest of the equity. So that could be a really helpful tool, for brokers who are just trying to find something locally for their client. In the event of someone trying to look for something like a triple net lease, there are portfolios that we have offered right now where there's 10 or 14 different properties in 14 different markets, and just like you said, they're bond grade tenants, and 10-year leases 10-year, 15-year leases on the property. Cash flowing, and there's business plans for the entirety of that portfolio. So it definitely can be a really helpful tool for investors who are looking to basically, again, feel that comfort level of knowing that there's a tenant that is S&P rated and has that investment grade that you typically may not get if you're looking for something either locally with like a franchisee or something like that.
Sure. No, that's great.
Yeah.
Well, and hopefully we can set up a separate podcast to talk about the entire other side vein of that business, which is the UPREIT concept, the conversion of that equity. That's a topic for another podcast. Yeah. But, all in all, I think that although as a real estate broker, we'd love to make the commission on selling our client an up leg and helping them do a 1031 exchange, at the end of the day, it's about the client's best interest and finding the right solution for them. And I've just been just amazed at the handoff that we've been able to do with you, and the end result has been fantastic. So
and I appreciate it, Kevin. It's been a really fun experience helping your clients out. I think it was a really fun time, and they're awesome. So I mean, you have great clientele.
Awesome.
Great clientele.
We appreciate that. And we look forward to working together in the coming years and helping other clients transition into whatever it may be. And if the DST is the right opportunity for them, we want to make the introduction and share all the great resources that you have to offer as a strategic partner. Skyler, I want to thank you for coming in and meeting with us at the Multifamily Movers podcast. The wealth of information that you shared was invaluable, and hopefully our clients will see value in it as well. And thanks again for coming in.
Thanks, Kevin. I appreciate it. And like I said before, I really appreciate the opportunity to help strategic resource for South Coast, your team, and all the guys here. And let's help some more people out.
All right.
The best way to reach me would basically just be to go to the website, alohawealthpartners.com. We're redoing it right now, so if there's going to be some upgrades to it momentarily. So that's basically the best way to get to us. The podcast is a discussion pertaining to one or more investment strategies and or asset classes, and is not a discussion of any specific offering, past or present, of securities. As a reminder, there's no guarantee that any investment or strategy will perform as targeted. Past performance is no guarantee of future performance, and any investment involves risk and the risk of loss in some or all principal invested. This podcast contains statements intended for educational hypothetical purposes only, and is not to be construed as a promise of performance. Information presented herein reflects the opinions of the speakers and is from sources believed to be reliable, but all information is subject to change. You should always speak to your finance and tax professional prior to investing. Securities are offered through Emerson Equity, LLC, member FINRA and SIPC. Advisory services offered through Aloha Wealth Partners, California Registered Investment Advisor. Only available in states where Emerson Equity LLC is registered. Emerson Equity LLC is not affiliated with any other entities identified in this communication. 1031 risk disclosures. There's no guarantee that any strategy will be successful or achieve investment objectives. Potential for property value loss. All real estate investments have the potential to lose value during the life of the investments. Change of tax status. The income stream and depreciation schedule for any investment property may affect the property owner's income bracket and/or tax status. An unfavorable tax ruling may cancel deferral of capital gains and result in immediate tax liabilities. Potential for foreclosure. All finance real estate investments have the potential for foreclosure. Illiquidity. Because 1031 exchanges are commonly offered through private placement offerings and are illiquid securities, there's no secondary market for these securities and investments. So reduction or elimination of monthly cash flow distributions. Like any investment in real estate, if property unexpectedly loses tenants or sustains substantial damage, there's potential for suspension of cash flow distributions, and the impact of fees and expenses and costs associated with the transaction may impact investors' returns and may outweigh tax benefits.